So here's a weird question for you. Does your investment portfolio have a birthday? I know, it sounds a little strange, but think about it. The strategy that's perfect for you in your 20s, it could be an absolute disaster by the time you're in your 50s. So let's dive into this and figure out exactly how your investments should, grow up right alongside you. Wow, this quote really hits the nail on the head, doesn't it? A static, one-size-fits-all approach, it just doesn't cut it when it comes to your money. If your portfolio never ages, your risk can get completely out of whack. So the big question is, how do you actually do that? How do you make sure your strategy evolves? All right, let's start at the very beginning. We're talking about your 20s and early 30s. This is what we call the growth years. And honestly, the goal here is super simple, but it's also incredibly powerful. Just build, 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 build. And the best part, you've got a secret weapon on your side. And that superpower? It's compounding. I mean, you've probably heard of it, but it's worth repeating. Just think of it like a tiny snowball at the top of a really, really long hill. As it starts rolling, it picks up more snow, getting bigger and faster. The longer the hill, the more massive that snowball gets at the bottom. Well, in your 20s, you have the longest hill ahead of you. Time, that is your single most valuable asset. So what's the game plan? Well, you've got to take advantage of all that time. This is the moment to pursue aggressive growth. We're talking about maximizing your exposure to equities, stocks, shares in companies. Things like systematic investment plans or SIPs are just perfect for this. They let you invest a set amount on a regular basis, which builds discipline. And speaking of discipline, a huge part of this is keeping lifestyle creep in check. You know that thing where the more you earn, the more you spend? Yeah, you gotta fight that. Instead of buying a fancier car, you channel that extra cash straight into your investments. Okay, let's jump forward in time a bit. Now you're in your 40s and 50s. Life looks different, right? You've probably got more responsibilities, but you've also built up a pretty significant nest egg, so it only makes sense that your strategy has to change too. Welcome to what we call the balancing act. And this right here really shows the pivot. It's a total mindset shift. In your 20s, it was all about one thing: maximize growth. Now, it's about protecting the corpus. That's just a fancy word for the main body of wealth you've built up. You've spent years playing offense, and now it's time to build a rock-solid defense. So what does this actually look like in practice? Well, a few things. You're probably boosting your retirement contributions. You're getting serious about paying down any major debt, like that home loan. And this is the big one. You start to gradually de-risk your portfolio. And I want to stress the word gradually. This isn't about panicking and selling everything. It's a slow, deliberate shift toward a more balanced mix of investments. And there's actually a name for the tool that helps you do this. It's called a glide path. The name is perfect, really. Think about an airplane coming in for a landing. It doesn't just drop out of the sky, right? It follows a smooth, gradual descent. That's exactly what a glide path does for your portfolio. It ensures you don't make any sudden, jarring moves, systematically shifting from higher-risk things like stocks to more stable investments as you get closer and closer to retirement. Which brings us to the final chapter of this whole wealth building journey. We're talking late 50s, 60s. This is the preservation phase. And believe me, the game changes one last time. At this point, your absolute number one non-negotiable priority is protecting what you have. And why is that? It's simple. You don't have decades to recover from a big market crash anymore. Imagine a huge drop in your portfolio just a year before you plan to retire. I mean, that could be devastating. So capital preservation becomes everything. So the priorities here become crystal clear. Step 1, preserve your capital. Lock it down. Step 2, shift your focus to generating steady income from those investments. And step 3, start seriously thinking about estate planning. How you're going to pass on that wealth in the most effective way. Okay, so we've gone through all these stages. What's the big takeaway? At the end of the day, it's all about avoiding two really common and really costly mistakes. These are the portfolio mismatches you absolutely want to steer clear of. And this table just lays out the danger perfectly. On one side, you've got young investors in their 20s being way too conservative, sticking to things like fixed deposits and gold. The consequence? They miss out on decades of that incredible compounding growth. Then you've got the other extreme, folks in their 60s who are still way too aggressive in stocks, basically risking a huge crash right at the finish line. You can see how both are just completely misaligned with their stage of life. So please remember this. Adapting your strategy as you age isn't about being scared or missing out. It's actually about getting the absolute best of both worlds. You get to harness that explosive compounding growth when you're young, and then transition to secure, reliable income when you're older. It's a complete strategy for your entire financial life. And that brings us to the final and honestly the most important question of all. And this one is for you. I want you to take a hard look at your own investments. Ask yourself, does my portfolio actually match my current stage in life? Because making sure those two things are aligned, well, that might just be the most important financial decision you ever make.